Well, there's a lot that can be done, but nothing that anyone wants to do. In fact, you could have gone back even further and avoided the 2008 crisis. This is the next one will be really the third in the sequence. The world came within hours of completely shutting down. I was the Council of Long-Term Capital Management. I negotiated the bailout. I was in the front seat on the phone with whether it's Treasury officials or the CEOs of major banks and so forth. And we did get it done. We brought it in for soft landing in that sense. But it was a close run thing, as they say. And if it had not got done, the Tokyo Stock Exchange wouldn't have opened that day. And one by one, exchanges around the world sequentially shut down, at least for a while. It would have been a lot worse than what happened in 2008. Mega bank mergers, maybe break up the biggest banks at the time, ban almost all derivatives. The exchange traded derivatives for that have a commercial use tend to be a lot safer. Perhaps those could continue. The financial crisis sort of calmed down in the winter, spread around the world, blew up with Russia in the summer of 1998, and then came home to roost long-term capital management. That was the hedge fund in the United States. People want to put words in your mouth. They say, well, Jim Rickards says this or Jim Rickards says that, most of which I never said. People say, well, he predicts the end of the world, sell everything and buy gold. I've never said that. I don't think it's the end of the world. You should have some gold, but not too much. But that doesn't mean we won't have a severe financial crisis that will change not just the economy, but the way people live, the way they interact. And so I'm talking about the aftermath of the last crisis and the aftermath of the next crisis, and kind of explaining why there will be a crisis, why there are cracks in the foundation. And that's really what the book's about. The specific issues, policy issues, facts, developments that will lead to a new crisis. Each crisis is more dangerous than the one before. So 1998, 2008, here we are in 2022. We're going to get to a point, we may be there, where the crisis is actually bigger than the Fed, bigger than the Fed's ability to stop. We are uncomfortably close. Now, it's impossible to know exactly how close because it's a complex dynamic system, and you can make very good predictions on complex dynamic systems as to the magnitude of the crisis, but it's very hard to get the exact timing. Well, there's a lot that can be done, but nothing that anyone wants to do. In fact, you could have gone back even further and avoided the 2008 crisis. This is the next one will be really the third in the sequence. The first one is 1998. That was started in 1997 with the Asian financial crisis, sort of calmed down in the winter, spread around the world, blew up with Russia in the summer of 1998, and then came home to roost long-term capital management. That was the hedge fund in the United States that it nearly failed. But if it had failed completely, it would have taken Wall Street down with it. Lehman Brothers would have failed in 1998. Forget 2008. Would have happened 10 years sooner. But instead, the major investment banks, the 14 largest investment banks, got together. They pulled $4 billion of cash, put it into long-term capital, and in effect propped up the balance sheet. They became the owners of the positions, of course, and then took about a year or slightly more to unwind it gradually, as opposed to doing that in panic. But the world came within hours of completely shutting down. I was the Council of Long-Term Capital Management. I negotiated the bailout. I was in the front seat on the phone with whether it's Treasury officials or the CEOs of major banks and so forth. And we did get it done. We brought it in for soft landing in that sense. But it was a close run thing, as they say. And if it had not got done, the Tokyo Stock Exchange wouldn't have opened that day. And one by one, exchanges around the world sequentially would have shut down, at least for a while. It would have been a lot worse than what happened in 2008. Well, obviously in a situation like that, there are lessons that could be learned. One is don't use excessive leverage. When I say don't, I'm not just talking about long-term capital. Long-term capital was an example of what I'm talking about, but it can apply to the system as a whole. Don't use too much leverage. Don't use derivatives, too much opacity, not enough information, bad risk management models, value at risk. A lot of the hypotheses behind modern financial theory are demonstrably false. It's not just an opinion. You can show it empirically that they're false. And you should have learned all those things. And one of the results would be don't repeal Glass-Steagall, don't allow any more mega bank mergers, maybe break up the biggest banks at the time, ban almost all derivatives. The exchange traded derivatives that have a commercial use tend to be a lot safer. Perhaps those could continue.